Broadcast. Welcome to the Zaner MarketCast, your one and only spot to keep up with all of the agricultural market news. I'm Joe Nikruto. I'm here with
And Hussey.
Dan Hussey. Here today, we've got some big stuff to cover. We say that every time, but this week it might actually be true. Prior to jumping on here, we were saying, okay, what's really happening? But what is really happening is you've got a Friday in front of a Monday, May WASDE report, say that 3 times fast. You've got U.S. and China visiting with some potential trade talks or some potential trade solutions maybe in Switzerland.
Resolutions, right? Yeah.
Right, yeah, there you go. Resolution. Yeah, trade resolution. The president signaling maybe some flexibility there in the last 12 to 24 hours. And we've got some price action that has left both of us maybe with more questions than answers, but we won't know what we think until we hear what we say. Friday, big weekend coming up. What do you got going on? Anything?
No, not a whole ton. These last couple of weekends, we've had some pretty quiet ones. I think we're going to continue to enjoy that while we can. Summer's right around the corner. So it'll be great to have, my wife's a teacher for those that don't know. So it'll be great to have her back around the house, like with the kids helping. It'll take some pressure off our own parent and other stuff. But no, man, I got nothing going on. I'm just a middle-aged dad now.
That's the way it works. That's the way we love it like that. We love it like that.
No news is good news, right? Like what? I'm not going to tell you about
family
business. Staff meeting, right?
That's right. So kind of just to jump right into it, if you look at, I guess if we want to dive right into this, our weekly update on what do you say, beans? That's a chart that caught my attention the most here this week.
Look the best, right? Where we're not crying and a sob story of woe is me, right? Beans are holding on. There's like actually there's a story there of hope almost.
I think so. July beans opened the week at 10.52 3/4. High was 10.58 1/4. Low 10.36 1/2. Last trade I show is 10.51 3/4. That was down 6 1/4 on the week. Technically there, what do you see?
I see a little bull flag here, right? There's in the process of kind of drawing up this technical pattern. It's nothing fancy, folks. It's just the market bought in a range. You got, the literal flag pole and then the literal flag pennant against this spaghettification of daily moving averages. The 18-day, we closed back above it here. The 200-day, we closed back above it. We stayed above the 100-day, and the 50 or 55-day was supportive down there. But this downward sloping channel, this pennant, we're above those moving averages. That's a good look, but it's really this downward sloping trend line that you look to break in this technical structure, right? Because everything inside of that has just been chopped. And we've been flagging sideways inside of a range at highs at a time where wheat and corn have really gotten beat up, where we've had nothing positive about soybeans. Everything has been negative, right? It's been negative news after negative news about Chinese tariffs and trade deals. That you'd think out of every agricultural product, soybeans would be the one getting absolutely shellacked from negative fundamental news. But here we are holding up.
And the reason they're not
pattern.
The reason they're not getting shellacked, funds came into the day an estimated long 33,000 contracts.
Wow.
Funds remaining long beans, long 57,000 contracts of oil, short a record 100,000 soy meal. And it could be, unlike corn, where the trend has been kind of an aggressive liquidation here over the last week or two, down from that rather large, getting large long position down to what is essentially long 28,000 contracts today. Beans not under quite the same pressure as the funds have just been seemingly standing pat, right? And so when you look at that chart, that channel does appear to be, we're not going to be, I guess what I would say when you think about July beans, we're not going to be asking this question for very long, right? I mean, you're either going to break out of this 1070
100%,
or you're going to fall below 1030 and then.
And I think you hit the nail on the head there, right? That there's kind of like two levels here. You're bullish above, bearish below in the very short term. That other line didn't work, but there you go, right? This 1030, 1040 area to the downside is 1060 is resistance. Everything in between is going to be chopped. If you're a range trader, boy, I hope you've had a heyday here. You can make a case for a little left shoulder, head, right shoulder. There's a neckline here, all these good things, right? This is a technical trader's chart pattern. The only issue I have with all these bullish structures is that if you don't get through this upward sloping trend line or this downward sloping trend line against the highs, you're in this otherwise kind of sideways, maybe bear flag. But
Yeah.
truthfully, I think when you take an even bigger step back on a continuation chart for beans, you start to realize, well, maybe we actually are probably down towards value. This is upward sloping trend line since 2022 or 2002, excuse me, right? That we're bumping into around $10. So, the chart is kind of saying, hey, maybe I don't really belong below $10 for very long, if at all anymore. But we're certainly sticking around to be able to test that principle in this marketing year.
And with all the negative news,
If we
as
want,
you mentioned,
right?
around soybeans, we aren't having a hard time finding buyers, are we?
No, and that's another amazing thing, right? We've seen those export sales to Mexico and Pakistan here today, right? And we saw some sales here the day before that. There you go, on the 8th here again. So quite an amazing kind of run for soybean sales here at a time of the year when we weren't totally expecting. Well, I guess this was corn. Oh, there's Pakistan coming in here, right? 2 days in a row for some sales, and that's not
First
including
time
what
in
we're
a
seeing
long
on the.
time.
And that's not including what we're seeing on the larger, right, weekly sales, right? Those are just our dailies. So those are, whenever we see those dailies, we always attribute it to a little bit more of an aggressive hand, right, trying to buy those beans. So it's really great to see.
July bean oil takes a little bit of a break here again for the second week in a row. Opened the week at 49, high was 49.67, low 47.29. Closed the week at 48.57, down 0.86 on the week. No small change there, but well up from the lows. That's a pretty decent look in bean oil. Maybe this WASDE has something to do with that.
Maybe, right? And you've got otherwise this market that's trying to, and if at the most basic determinant idea here is that you're making higher highs and higher lows still on this daily chart. It's these big swings. I guess it's almost a monthly chart. But you really want to see bean oil break out of that 50 area. That's basically been resistance going into last year and even back to 2023. So we've been coiling up below these levels, and without breaking above that, I am always fearful when you're at the high end of those ranges and some of these byproducts. It's tough because they can roll back over to the low end of the range very quickly and very dramatically. That 18-day moving average, I will say we did break back below it, and did find it as resistance here today. But hey, we get back above that. This is nothing more than a couple days of a technical chart break. It happens from time to time on the chart when you look. Otherwise, really, the cluster of bigger supportive areas are probably down around 46 to 45. But hey, I'm willing to come out here and say we get a little more bullish back above that 49.80 to 50 area.
And from time to time, that chart says, hey, we would like some clarity on this biofuel policy.
Absolutely,
these
right.
breaks where the price action gets a little tired. And even though that chart to me speaks of hopeful, and maybe not even hopeful, maybe that chart is anticipating what we expect to be some positive information, some positive clarification about U.S. biofuel policy. But you could see where from time to time people say, okay, I'm tired of waiting. My patience is wearing thin. I'm going to get out of this position. Next week, they'll put it back on.
Absolutely. And that's where these ranges will get chopped up, and there'll be, again, and then you've got those commercial interests, like you said, and playing into, their needs and getting it back on when they need it. So
July soy meal opened the week 296. The high was 299, low 292.60. We closed the week last trade. I saw 294.10. I was down 280 on the week. Soy meal, that chart, I don't even know what to say.
Looks like the VIX, but it just is like this grind into an oblivion into this 290 area. It really doesn't want to stay below 3 for very long. Like it comes down here, but it seems to want to try to pop back up above 3, and it's just a matter of timing, I suppose. We did every time that stochastic RSI gets a little oversold, I start to think about when that next pop is coming. I think it's a little too premature here at this time, but man, it's just grinding lower. And at some point, I'm hopeful that you'll see that rally with bean oil through some of those key figures and a turn here in the meal, and that the entire soy complex and soybeans outright can probably rally. But below that 18-day moving average, 297.60 last there, 55-day up around 302, the 100-day around 308, 200-day up around 314. There's plenty of places to find resistance on this chart if we do start to find a rally anyway. But boy, oh boy, it's losing momentum into eat flow, and
funds short 100,000 contracts.
And every time you want to scream, contract low, right?
I could be interesting when the funds have to turn on that position. And I'm not sure what I'm trying to imagine, right? What fundamental takes us out of that, right? What is it what has to happen to get the funds to cover that soy meal? Technically, you mentioned what has to happen. We have to get out over some of those areas of resistance. Fundamentally,
Definitely some lines on the chart we can look at, right?
Yeah.
But fundamentally, is it a trade deal with China perhaps right now? I think that would be a news headline that would help at least. And then exports, right? We just want to see exports.
Let's jump to another chart that just sucks. Wheat. July wheat on the week chart damage. There really wasn't, I don't even know what to call that. Opened the week at 540, what was that? 545 and a quarter. High was 548, low 520 and three quarters. Closed the week at 521 and three quarters, right on the lows. Down 21 and a quarter on the week in July wheat. Never be good again.
No, but I will admit this little downturn and downward sloping kind of triangle and loss and divergent momentum kind of move into the lows. This right here looks a lot like this right here. So at some point you do anticipate a run up like this, as a technical trader. But like you said, never going to be good again. Why would you buy wheat here? You're picking a bottom that really hasn't worked out for wheat traders this year. Yeah, if your timing is right, you can catch a nice run up, but this is technically still a bear trend. It's still below all your technical indicators. That 18-day has been resistance. So then a couple of days there that we broke above the 55-day and 100-day there. We couldn't even, get back above it through April. And the 200-day remains basically untested since earlier this year. So wheat prices just stink. And we are just finding out how low down or how low the buyer will let it go.
Yeah.
That commercial buyer, where's demand? Where is demand?
Funds short there, 114,000 contracts of Chicago wheat is the estimation.
Wow.
That is a big position, big short position in wheat.
And when they finally want to, you'll get that. They're going to move just like this when they finally want to get out. You can see some of those things. But we could overlay that fund position and see them covering out, right? Then building back in, covering out, building back in. And hopefully, one of these days they'll cover back out. But even at 100,000 short, Joe, I mean, they could still get shorter if they wanted to.
So I would
more
imagine,
short.
I would imagine that for a lot of our listeners, and with the fundamental, there are a few bright spots, right? You've had some weather challenges in certain spots.
Mm-hmm.
There has been some dryness in China. Chinese have signaled, maybe intentionally or unintentionally, they've made some purchases from Australia. Correct me if I'm wrong. Australia. And then another source, I can't remember, was it Argentina? But you got to fact check me on those sources, but they made some purchases that has caught folks' attention. Is it possible, you think about the bulk of our 5 or 6 viewers here for the MarketCast, do you think that 2 or 3 of them are trying to catch this knife by the handle? And can that be this week's educational feature, educational opportunity? Dan, how do we catch this knife? How do we attempt to catch this knife by the handle? Certainly, I've got an account with $500,000 in it, and I'm thinking that I'm going to buy this wheat market with futures. Tell me a better way.
Yeah, if you got deep pockets and you want to just hold through the pain, right? That's one way. But boy, I think Joe and I would both agree that there's a better way. And there's always a better way, And if you're looking to try to catch a reversal, first and foremost, or be a part of the upside when it finally comes. First and foremost, I think I like to talk to a guy about how, okay, maybe we wait for one of those reversal signals, like the Q reversal or something like that. Some reason to be a buyer. Give me a green shoot. Give me a reason to be a buyer, right? Okay, but outside of that, I'm hell-bent, Dan. I got to buy this thing now. I got to own wheat right here and now. How can we do it? That's where call options. That's where something with a finite risk profile is going to be a much better solution than just trying to catch the falling knife. For a couple of reasons. One, you know exactly what your risk is going to be at. You're never going to get bottom ticked or ticked out of the market in case the market capitulates, goes down 50 cents in a couple of days, and snaps right back up, which is completely something wheat loves to do, right? When wheat makes those big bottoms, it can drop 20, 30, 40 cents and be right back up where it came from. Wiped everybody who was in a futures position out that got leveraged and margin called out. But if you're in an option, you could still have a shot of actually being a part of that. There's a better way, right? And that finite risk of owning a call, while it's not as glorious and as fun as owning futures, it will give you the peace and protection and the peace of mind of, if you, in the event that you're dead wrong, that you can only be so wrong. And that's what's important in some of these instances.
Important to note to our viewers and listeners who are people of action, this is not a trade recommendation, not in any way, shape, or form. This
Not
is
in a way, shape, or form.
This is more of a mindset recommendation. If you are dead set,
That's a great way of putting it, Joe.
If you are dead set on trying to grab this knife by the handle, it does not have to. You do not have to hit this one out of the park, right? Wheat's going to bounce. Maybe it bounces 10 cents. Maybe it bounces 80 cents. Who knows? When it bounces, it's going to bounce nicely. If you are there, you will have to be in to win. But if you are there, there's a lot of there could be tremendous potential benefit. But if you do this in a way that is not thought out or does not fit your risk profile, financial damage, just there's no sense in even taking that risk. And that's why it's a good idea for us to talk about these call options, because as you mentioned, and not as a trade recommendation, but as
a tool. It's a tool,
exploring an idea. Absolutely. It is absolutely a tool. And so you are going to limit your potential return, but you're also, more importantly, in a downtrending market, you're going to limit your potential exposure. And so, as Dan mentioned, the finite risk, even with a 540 call, they like you to pay like essentially 29, settled at 29 and 7/8, right? So it's a 536.5 September market, 105 days to expiration. And again, not a trade recommendation, but what we're saying here is, when you think about options and you think about trying to take a position and be in the way of a market that can reverse dramatically, suddenly, this is kind of the way that you want to do it. 540, 560. I'm sorry, 540, 550, 560, anywhere in here from 22.5 all the way up to almost 30, from 560 to 540. Those are great places to start. You would likely want to maybe put a full dollar spread on this, Dan. I don't know about you, but like a 550 to 650 appeals to me, because it looks like you could get that up for, looks like you can get that done for around 20 cents, maybe 18, if you wanted to put kind of a fantasy level in there and maybe catch one more week of lower prices. 18 cents, 550, 650, 20 cents gives you exposure to a full dollar. You're going to net almost 80 cents, 78 cents if you factor in costs.
And even most aggressive, right, call spreads we can go after, right? If we're confident the market, and because of 105 days here, if we're thinking maybe I want that exposure only if we go back about $6 because, hey, I'm sold at $6 or something to that effect, right? You could get into, right, the $6, $7 call spread here for even cheaper if you're looking for even less exposure over that same time frame. You just shift that scale. And the point here that Joe and I are trying to make with turning the head from just the simple, oh, I'm going to buy a futures to re-own or to speculate on higher prices, there's other ways to get that very similar or that same directional exposure with a different exposure profile or different risk amount or finite risk amount or all of these things. Like this strategy is a way of tempering risk. And that's what Joe and I are always there to discuss, is all those alternatives, right? But like I was about to say, the $6, $7 going for about 9 cents for more of a longer term, or I'm sorry, a longer shot or a much cheaper upside ownership strategy as well, right? In case you don't want to shell out 20 or 30 cents, but in this environment, it might be worth it. All depends on what that risk tolerance level is for you. And that's where Joe and I are here to always have a discussion with you. We'd love to talk to you about what that means for you.
And Dan, some viewers probably, as we roll through this, you and I having done this for more than a few months, we throwing around terms like delta and spread and the expiration time frame and what that means. I think we would both agree, an easy agree, is that we don't necessarily need our listeners to be, or our viewers to be expert on this. But what we do for folks who are looking to put up a trade like this, or who may be using options to hedge with, we simply talk through it. And when we bump into a term that maybe you don't have a full handle on, we just say, delta, what do you mean? And then we say, okay, that's simply the movement of the option that you can expect based on a 1 point move in the futures contract. And so in this case, that 550, what did we say? 550, 650 for September,
That dollar wide 20-cent cost
yeah.
spread.
So your delta there is 45. Let's just call it 45. So initially, even as the market begins to move, you're going to see almost a 50% increase or 50% movement in your option price based on the movement in the futures. And that's pretty good, right? That 50% delta is what I like to say is pretty juicy. And then when you factor that 650 on there, you're 50 minus the 14 delta, 60, 650, 550, 650 spread, that's still 36 delta. That's pretty good. And as the market moves through that 540, if the market were to move through that 540, and again, not a trade recommendation. We're just running through this for purely educational purposes, just to show you how you can take positions, even in what is one of the worst downtrending markets we care to look at today, right? Wheat, like you look at that wheat chart and say, that'll never be good again. But a lot of smart folks are looking at wheat saying, this thing could turn, this thing should turn.
At some point, it will be, but
right,
wait, it will be
exactly.
worth something.
Funds might be out over their skis, and there may be an opportunity to take advantage. But this is simply educational, simply saying, hey, there's a way to do this where you go to sleep with the same risk and you wake up with the same risk. And that is one less thing to worry about. You know what I mean?
Absolutely.
Moving along, if I can, Dan, if you'll allow,
yeah,
we get back to, so we took the Band-Aid off with wheat. That was horrible. Glad we don't have to talk about wheat again until next week. But corn getting drugged along with wheat here in the last couple, 2, 3, 4 weeks. We really had a nice run up, right? Ran up to 5 almost. And here we are with another week of rather severe. On a daily chart, it looks severe. As I look at this weekly chart, it does not look so severe, but depending on what your time frame is, we opened the week at 469 in July corn. The high was 470 3/4. Low was 442 1/4. We closed at 449 3/4. I think a lot of folks were hoping for a higher close here in front of this WASDE on Monday. That was down 19 1/4 on the week. Funds were coming into the day only long about 28,000 corn, down from maybe 128,000 long.
Wow.
You're only long 28,000. Now the funds have been on the offer, pressing this. Dan, I've seen some really big volume on the opens and closes too. Somebody's trying to muscle it a little bit. Maybe this is not the appropriate venue for my foil hat rantings and ravings, but certainly the corn market has not been without volume on these breaks, right? I guess I could say that politically correctly.
Yeah, that would be correct. And it's a big breaks through some big levels, right? That's not an insignificant 200-day moving average we're now below, not an insignificant upward sloping trend line that we're now below, right? The 18-day and the 55-day have crossed back below the 100-day moving average. So these are not positive technical developments on the corn chart, unfortunately, for the daily chart.
Not at all.
But, I also am willing to admit that when we go back in time and you look at larger time frame continuous charts, corn does have a tendency to, after these big breaks after going through their inflationary tops, to go through these kind of just sideways range-bound markets. So you don't really get a trend. You get these short-term seasonal trends, just pops in price action as supply and demand and different weather premiums and everything else play out throughout the year. And I think we're just starting to see some of that, right? We're starting to find that range, in my opinion. So I think $4 to $6, maybe $4 to $5 is where corn's going to start living for a bit on the bigger time frame. That's what we're signaling here. That's what the chart has told me, is that don't expect that big run up to $6, $7 in corn anytime soon without a significant shift in the narrative. That's probably going to mean, who knows what that could be, right?
Weather
that
seems to be
a
the
Trump tweet. Who knows?
Right? Yeah, weather,
Seriously.
Trump tweet. And the
A lot of
Chinese
things
have been
can
staying
change.
away. Chinese have been staying away from U.S. corn in droves for some time.
Yes. Still getting Mexican buyers, though, and other other trading partners should be picking up the slack. So that's good to see.
Right.
But yeah.
Right.
But and I think that's where you're seeing December corn, relatively speaking, here hold up a little bit better. This is almost a double bottom kind of here. It's still below those same technical levels. Not a great look, but December corn also never got as much of a rally. It was always more of this range bound market since September, where July and old crop corn seemed to have been starting a trend and then just failed that trend. I'm not saying it can't pick itself up by its bootstraps, but we would need that narrative shift. WASDE report, we need to get us back above that 200-day moving average. All those things would need to happen to convince me otherwise. But December corn, like you said, interestingly enough, has not fallen as much in this last decline as our old crop or our new crop has. Old crop has.
Seasonally, we're supposed to find a bottom
time.
here somewhere, right? Seasonally, we're supposed to find a bottom here somewhere.
Which it feels like
next week or two.
new crop is trying and feeling out something. Because look, this is all within 10, 15, 20 cents of like contract lows right now. It could have knifed the lows if it wanted to. So
I wonder, is this corn chart more a function of what's happening in wheat?
possibly. I almost feel like today's corn chart was a function of I want to go up, but wheat's not letting me. I want to follow beans, but wheat's not letting me.
Cattle market now here, tale of two cities, right? Corn and wheat can't get it going, but feeders and fat cattle.
Are we
just
sure this
can't
isn't
be
a chart of
stopped.
cocoa? I'm going to keep making this
be
stupid
stopped.
joke every week.
Yeah,
Right.
and it's getting the chart is getting more cocoa like every week. That joke is getting realer and realer every week that passes by. How about June cattle? My goodness. Opened the week at 211. The high was 215.60, low 211. Closed it at 214.67.5, right near the highs.
I mean, that's just
214.67, up 357.5 on the week.
the quintessential bull trend. There's nothing else you can say about that. All the SMAs nicely spanned out, got higher highs. I mean, poking off to new highs. I will admit the most recent candle in the close there. Be funny if that's the top tippity top, but no, it's an uptrend until it's not, folks. We're into uncharted territories when you get up to these all-time and contract highs with markets. They can continue being irrational along there. Then you can stay liquid if you're trying to pick a top and sell this thing. There's a lot of fundamental reasons why cattle prices are the way they are, right, Joe? We've got small herds. You've got consumer demand for red beef meat that is just insatiable in the U.S. I would imagine if we saw strong international demand, that would just send prices. Could you imagine if we had even stronger export demand for U.S. beef right now? What would that do? But that's exactly why prices are going where they're going, right? You have too few animals with too strong of consumer demand. This is what it looks like, right? The prices of everything keep going up because people can't get enough animals through the system, can't get enough beef on the table. What else can we say? Eventually, this is going to run its course, but it's not going to be demand. Where demand is going to have to be price rationed. And the only way that happens is from higher prices.
An interesting thing too, shout out to customer Kevin, who mentioned the other day that, okay, so if your international market, if there are some changes, right, we saw a cancellation or two of Chinese orders for US beef, and they seem to have quite an appetite for it, much like beans. We'll see if they can do without it. From what I understand, the Brazilians have marched over to China to try to take advantage of the current discord, as they do so well. So we'll see how that plays out. But at the end of the day, U.S. beef on a plate, beef from anywhere else in the world, your beef eaters, I don't care if you're in Singapore or Botswana or wherever, U.S. beef is the answer to whatever the question was. But the interesting thing that client Kevin brought up is, go ahead, if your international demand does dry up a little bit and you have to find a home for these cuts here in the United States, that means you bring prices down a little bit. Imagine the American house person walking into the grocery store and finding cuts that maybe they have put on the back burner, no pun intended, now on sale. There's just that stuff's going to be flying off grocery store, out of the grocery store cabinet.
Yeah.
You know what I mean?
If I saw a good, ribeye or some fillets or, even a T-bone, like at a good price, like every time I walk down the aisle, I grab anything that's on sale, like red meat in a heartbeat. Won't even second thought.
The conundrum continues here is that you are not getting any development, in terms of, heifer retention, because the numbers are so great. If you take, you get them to market, you get paid. If you bring the price of this stuff down, you're not going to have any difficulty clearing this stuff here at home. And so it's hard to see how this changes. We know that it will. We know that we're going to look up here one of these weeks and you're going to have one of these big dramatic breaks, but it's difficult to see why that would be for any other reason than the packer decides that's how it's going to go. But even they trying to limit kills, it would appear. The slaughter numbers have been down a bit compared to with year-over-year comparisons. And I just don't see how this is going to change.
Higher prices. That's how. Yeah. It's price rationing demand. Everything we talk about, it's like we don't see where demand's going to go anywhere. And the only thing that will change that demand's mind is when they go, that's too high a price. That's too pricey for me. Because if unfortunately, if supplies continue to dwindle, we're just going to keep bidding it up, aren't we?
Yeah.
It's just the
Yeah.
nature of economics.
That brings you to ideas here that in the US, your consumer may be a little stretched.
Yep.
But even that's hard to see from this chart. Even that's hard to see from the cash cattle numbers, cash trade numbers. You would expect to see maybe some break in that stuff, but you're just not seeing it. You're just not seeing it so far.
Well, it's maybe that's the new normal for our modern man. Is that we can, as a society, we can afford to not really have to break on our food quality or what we're putting on the dinner table. Maybe that's just not where we're breaking in our discretionary spending these days. I don't know.
Good
Because
point.
you're right.
Good point.
Because you use other places in the used car markets and home sales and other things that are starting to slow big ticket items, but certainly it hasn't hit the grocery store just yet. At least, I don't know. My consumer spending habits at the grocery store haven't changed. People are still willing to spend $6 for eggs. So I don't know. Although the egg inflation seems to be gone too, right? The prices of other things have come down. Maybe we have room in our pocketbooks for a higher meat price. I'm just playing devil's advocate, but hey.
Yeah, and that's got to be, and you have to, with a chart like this, you have to look at this thing. Unfortunately, I think we could sit here until tomorrow.
Oh my gosh, yeah.
We could. Very difficult to find, very difficult when you get up here like this. Now we're in a land of how high is too high. And
100%.
historically, when you look at markets like this, and it's hard to imagine that it can be that way because it's cattle and because of what is still a rather robust trade and what is still rather an independent producer. But that seems to be what's happening here, is that the market is doing what the market can do. Can you tell me, please, May feeders, are we still front month? Should we be looking at May or should we be looking at August?
And are you quizzing me? August feeders have 7,500 contracts traded today. May had 2,300. Open interest is definitely in that August at 40,000 here.
So we switched to August 25 and the weeklies on that. Say we opened the week at 296.47 and a half. The high was 301.90, low 295.95. Last trade was 300.30, 300.30. That was up a whopping 340 on the week. 340, some weeks not that big of a deal, but to be up 340 into this rarefied air, that is a heck of an accomplishment. And in my opinion, speaks to the fact that this thing at this point in time just can't be stopped. Not quite a close on the highs there, right? If you're looking for something that says maybe we can cool this out.
Yeah, maybe, right. But
closed in the upper half, right?
And to be fair, any chart that looks like this, I think you got to be ready for some kind of pullback, right? At any given point in time. And the question is whether or not that gets gobbled up and snapped up by the bulls to take you to a new high, right? 18-day moving average down around 294. That's also another high that we broke out from back in March. So maybe some technical support now down just below that 300 level around 295 that I would expect us to probably stay above in the short term if we're going to continue to creep higher. We've proven there's much bigger support down around 280. If we saw a bigger break, I would not be shocked either to see it break all the way down to that type of level, because in these types of markets from these types of price levels, you got to be ready for bigger, more volatile moves. And I don't mean to scare anybody or try to be Nostradamus, but I think everybody should have on the tip of their tongue the idea that limit down and limit up moves in this type of environment are highly probable. I'm not saying betting on them, or you just in trading, we expect the worst, prepare for the worst, and hope for the best. It would not take much, right, to send this market limit down on just funds trying to take profit, a take profit move that then also doesn't end up being the top as well, because we saw that in a few not too long ago either. But hey, anyway, not try to be a dormer, because it's still very much an uptrend, and it's been amazing to watch this rocket ship continue.
But you don't have to look very far back on this chart to get a clear indication of what you're talking about. When this contract bumped into 294 and couldn't quite get over it, I can't remember exactly what it was that changed.
And certainly, you could just say technically the 18-day, we just opened below it. They said, nope. I forget what it was right there at the start of April, some headline, right, that shocks the markets. And you had 2 days of limit down. And
man, did they move through that awfully quick. So one day you're knocking on the door at 294. The next day you're laying down at 295, 292, or 293, as a matter of fact. And so
they'd even bottomed to 273 a couple of days ago.
What you're saying bears repeating. This thing, when it turns, it's going to turn dramatically. And I think if we had a dime for every time we sat here and said, hey, get ready for when this thing turns, we'd probably have a couple dimes on each table. But
And I think that's at
predicting
least worth like a little shout out for, hey, cattlemen and producers out there, ranchers out there. Beef prices are great. If you don't have good insurance or haven't looked through insurance packages, come talk to Joe and I. We can look at some risk reversals, some put strategies, something with finite risk that can actually get a floor in here and lock in these prices for you. Because I think we all can agree that if you can get the highest price you've ever seen for an animal, you got to take it. I think that isn't that the name of the game, right? Isn't that the name of the game?
LRP, what you're inferring, LRP is a very novel product, and we certainly think that folks should explore all the tools in the
Right.
toolbox, but it doesn't quite
It's
get you
just
all the way
a
there.
PSA. Hey,
Yeah, it
we're
doesn't
at
quite
these
get you all the way
awesome
there.
prices. Think
Yep.
about your margins. Think about the job you have to do in protecting the value of your herd. And these are great prices to be doing it at. You know, I'm not saying you put yourself in front of the margin man, right? And just come out here picking top, selling feeder contracts. But right, like, you know, as a producer of any commodity, it's your job to try to sell at the highest price. And I'm looking at two of the highest closes that we've ever had in feeders and fats.
That concludes the weekly update portion. Dan, do we dare take a quick look at pre-WASDE? WASDE
Yeah, we
on
can.
Monday, 11 a.m. Central Standard.
Sure. Why don't we take a quick look at this?
Trade estimates for USDA May U.S. corn and soy production. U.S. corn and soy production. Average trade estimate in corn, 15.787 billion bushels with a 181.1 yield is the average guess. The high range, 182.20. The low, 179.30 for beans. Average trade guesstimate for production, 4.338 billion bushels with a yield of 52.5.
Yeah, you think it's going to be a quiet report, but the way the markets are moving, you think you feel like they're building up or just waiting for it. I think I'd like to see those lower bean numbers, but I think we're going to start the discussion of where they're adjusting demand side of these reports is really going to begin here, and the adjustments to those exports is the big thing that I think people are definitely looking, and at least I'm fearful over of how far down those can come. But I'm also thinking that my 2 cents is that the USDA is probably going to be kicking the can down the road a little bit more with reports this year and earlier in this year, because it's particularly with some of those demand estimates, because I think they're going to be waiting to see how trade deals and other things play out to affect the equation that they need. Otherwise, they need to stick to the mathematical equation that they usually need. So just keep that in mind, folks, is that they may be a little bit more hesitant to take risk and changing things from what they've already told us because of some of the major unknowns in the macroeconomic scene.
Trade estimates for USDA May U.S. grain ending stocks. Average trade estimate in wheat in billions of bushels, 0.850. Corn, this may be where the surprise is, right? Corn, average trade estimate, 1.443. Some whisper numbers in the 1.2 area. Soybeans, 0.369. Average trade estimate. I'm not sure that 25, 26 numbers. We'll see what that is on Monday.
Yeah.
Interesting in that if there's going to be a surprise, maybe it's in that corn number. I don't know. 1.443. In April, you were 1.465. Highest trade estimate is 1.515. Lowest trade estimate, 1.385 billion bushels. So that lowest trade estimate kind of knocking on the door of that 1.2 whisper number. So maybe it's not quite the whisper number. I don't know. But to me, if there's going to be a surprise, that's where it's going to be. That's trade estimates for May world grain ending stocks. Wheat, average trade estimate in millions of metric tons, 261 million metric tons. Corn, 287.07. And beans, 122.50. I can't remember that global number in beans, not super burdensome. Can you educate me on that?
Yeah, no, I don't think that's a huge, like, that's the thing is I think when you take China out of the equation, we're starting to get to some pretty tight stockpiles. And particularly that corn one, right? And I think that was a takeaway from when we were back at, oh my gosh, Commodity Classic, Karen Braun's
Sure.
presentation. That ending stock number for corn globally is incredibly tight still, or the stock to usage ratio is still really tight. So I think that's also where there's that narrative that corn would surprise here. And it might begin, Joe, just like you said, on the USDA balance sheet here on the US side, with everybody knowing tongue in cheek that on that international side, that there is a story going on there as well.
It certainly lends credence to this corn market that's going to find value here in this 440, 430, 420 area.
Right.
And on a daily basis, you look at this, you come here for the last however many days and corn market's been under pressure, difficult to get that feeling. But then when you scale out and look at it in the larger context, this is kind of where it checks up. And it checks up like this because of not only your U.S. supply available, but your global supply available, and it isn't really burdensome. Maybe your new crop numbers, maybe they're going to pitch some new crop numbers that are knocking on the door burdensome, but your old crop numbers not quite yet. How about trade estimates for USDA May South American production in millions of metric tons? Average trade estimate for corn in Argentina 49.75, beans 49.25. The Brazilian numbers, which are probably more interesting, 126.96 million metric tons in corn for Brazil, and in beans, 169.17. That's your average trade estimate. Highest number in beans is 170, highest number in corn for Brazil, 132.40, a little bit different than that 126.96. And then the lowest trade estimates, 124 and 168. So surprise to the upside. USDA with Brazil, that's not quite their style, right? They're going to wait and wait on Brazil, and then you're going to update them 6 months from now.
And I think that argument for the trade issues going on with the U.S. and China also lead to hey, let's see how much they actually bought from Brazil kind of mentality too, and updating some of these numbers. So, yeah, I guess I'm more in the camp of thinking they may be kicking the can on some of these numbers, some of these updates, but I don't disagree. That's where we're going to be looking for some of those bigger changes then down the road as they update them, because, hey, what's the number? It hasn't moved for how long? The longer things remain like unchanged or unbalanced with where we feel they should be, the more out of whack and more inefficient that market data is becoming. So we'll see.
Practically speaking, in corn, you might be looking for initially your new crop carryout numbers to weigh on the market early on. And then I would guess all bets are off after that, and we see how we close, right?
Yeah.
You're right back to looking at weather and demand. And demand so far has been great. Your export window's open for some time yet. And now you're just watching out the window to see if it rained or not, I guess.
Yeah. I've been talking more and more with clients about how we need to just get into the next narrative for the market to really get price action alive again, whether that's up or down. And I think everybody's starting to get back active in the fields if they're not already. There's things to be done. And so this is usually a time of the year where markets start to pick their pace up a little bit. And we'll see if some news won't, and the WASDE report here in a couple of days won't spark that.
Absolutely.
Did we get a question from Carter, or are we just going to running, biking, or swimming? Do I prefer running, biking, or swimming? Yes.
Yes. That's very funny. You prefer all of them.
Yes.
Also, we want to remind our viewers that the U.S. and China are visiting over the weekend. I think maybe we talked about this in the beginning, but it's worth repeating. So we want to pay attention on Sunday night. Not that we anticipate, you and I both were discussing that we don't quite think that they can come to any conclusion this weekend, but
probably not this weekend, but I think
attention.
Right. And probably not this weekend. I think that'd be amazing if they did. I mean, awesome. Go world. Go humans. That'd be great. But I think that I'm optimistic they will get to a deal. It's just a matter of how much pomp and circumstance, saber rattling, hot air, arm wrestling are the two sides going to have to do to get there, right? Because China doesn't want to look and make a deal that makes them look weak on the international stage, and Trump can't get the deal that he can't not get his deal, right? So something's got to give, right? This is a unstoppable force meeting an unmovable mountain to some extent, but we have to remember, just 4 short years ago, these two administrations did get deals together and done, and I'm optimistic they'll be able to again.
Good point. My answer to the question of the week is, if I don't, in the next 3 hours, if I don't get my radiator switched out, easily. I'll be preferring bicycling to the shore, to the Indiana shore, Lake Michigan, where I'll swim to Chicago and then run to the office. And so hopefully I won't have to engage in any of that, and we can get this radiator pulled out and put
an
back
accidental triathlete. That's awesome.
Heaven forbid. Heaven forbid. Wish me luck.
Thanks for listening to the Zaner MarketCast today, everybody. If you need more just because you can't get enough of us, you can follow us on Facebook at Zaner Egghead, on Twitter at the Zaner Group, and on LinkedIn as well. If you have a question you'd like to hear answered on the show, you can do so by filling out a form that's in the comment section, and we'll get it answered for you right here on the air. Thank you again. Be sure to like, comment, and follow the podcast and not miss a beat. And we'll be back with you as price action develops. Take care, everyone, and have a great
weekend, everybody.